Hello and welcome. In this video, we're going to walk through a comprehensive business combination problem. We'll be focusing on a statutory merger, where one company acquires another and the acquired company is dissolved. Our goal is to correctly calculate the consideration transferred, determine the amount of goodwill, record the necessary journal entries, and ultimately prepare a post-combination balance sheet for the new, larger entity. Let's get started. First, let's analyze the transaction. On the 1st of January, Newtune Company issues 18,430 shares of its common stock to acquire all of On the Go. This is a stock-for-stock acquisition. The first crucial step in any business combination is to determine the price paid, or what we call the fair value of the consideration transferred. The problem states Newtune issues 18,430 shares, and each share has a fair value of $50 on the acquisition date. Remember, under the acquisition method, we always use the fair value of what is given, not the par value. So, the total consideration is 18,430 shares times $50 per share. That gives us a total consideration transferred of $921,500. This is the purchase price. Also, note the $32,700 in stock issuance costs. We'll deal with those later, but it's important to remember they are not part of the acquisition price. They are a financing cost. Now we move to step 2, determining the fair value of the net assets we acquired. The rule is that we record the identifiable assets and liabilities of the acquired company On the Go at their fair values on the acquisition date, not their old book values. Here we have the list of On the Go's assets and liabilities at fair value. Notice the in-process research and development of $215,250. Even though On the Go had this valued at zero on their books, under acquisition accounting, we must recognize it as an asset at its fair value. This is a key difference between internally generated research and development and acquired research and development. If we sum the fair values of the assets and subtract the fair values of the liabilities, we get the total fair value of On the Go's net identifiable assets, which is $889,100. Now, we can calculate goodwill. Goodwill is the excess of the price we paid over the fair value of the net assets we received. It's a plug figure that represents all the intangible assets that we can't separately identify, like customer loyalty or workforce synergy. So we take our consideration transferred of $921,500 and subtract the net assets of $889,100, and that gives us goodwill of $32,400. With those calculations done, we can now prepare the journal entry on Newtune's books to record the merger. This is where we bring all of On the Go's assets and liabilities onto our balance sheet. First, we debit all the assets acquired at their fair values. You can see the list here: cash, receivables, trademarks, and so on, all the way down to the goodwill of $32,400 that we just calculated. Next, we credit the liabilities we assumed, also at their fair values: accounts payable and notes payable. The main credit is to equity, for the shares we issued. This is a two-part credit. We credit common stock for the par value of the shares issued. That's 18,430 shares times the $4 par value, which gives us $73,720. The remainder of the consideration goes to additional paid-in capital. This is the total consideration of $921,500 minus the par value portion of $73,720, which equals $847,780. Now, what about those stock issuance costs? They are not an asset, and they don't increase goodwill. Instead, they are treated as a reduction of the proceeds from the stock sale. Therefore, we debit additional paid-in capital and credit cash for $32,700. Alright, for our final task, we'll prepare the post-combination balance sheet for New Tune Company. The formula for each line item is simple. It's New Tune's pre-combination book value plus the fair value of on-the-go's assets or liabilities that we just recorded in our journal entry. Let's start with cash. New Tune had $67,750. We acquired $37,250 in cash from On the Go. But remember, we also paid $32,700 in cash for stock issuance costs. So the final cash balance is $67,750 plus $37,250 minus $32,700, which equals $72,300. Next, receivables. New Tune had $104,250. We acquired On the Go's receivables at their fair value of $84,200. Total receivables are $188,450. Now for the equity section. Common stock for New Tune was $400,000. We issued an additional $73,720 at par value in the merger. So the new balance is $473,720. Additional paid-in capital is a bit more complex. New Tune started with $30,000. We credited additional paid-in capital for $847,780 in the merger entry, but then we debited it for the $32,700 in stock issuance costs. So the final balance is $30,000 plus $847,780 minus $32,700, which is $845,080. Retained earnings is unchanged. Remember, in an acquisition, we do not combine the retained earnings of the acquired company. So New Tune's retained earnings remains at $868,000. Once all the accounts are combined, we can total our assets and our liabilities and equity. Total assets sum to $2,795,650. Total liabilities and equities also sum to $2,795,650. Our balance sheet balances, which is a great final check on our work.